My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people and my friends, I'm just trying to make you a little money. It's my job, not just to entertain, but to teach, educate. Call me, 1-800-743-CBC, or tweet me at Jim Cramer. Okay, listen to me. Throw out your economic textbooks. Trash the stock treatises. Ban the bond histories. They don't matter anymore. Everything we thought we knew is wrong. Or at least that's what today's action was saying. With the Dow gaining 305 points, the S&P jumping 1.11%, and the Nasdaq pole vaulting 1.31%. All right, what's so unnerving about that, about the tape? What is that about? Simple. The Dow Jones Industrial Averages hit a new high right as interest rates cratered. The Dow's the most cyclical of the major indices. When it breaks records, that means the economy's supposed to be booming, correct? And when the economy's booming with strong inflation, interest rates are supposed to surge, not collapse like they did today. You can't have a boom and a bust at the exact same time, can you? Well, until today, I would have said that's impossible. See, I am expecting a boom. Something I find more confirmation of every day. Just this morning, I interviewed Ed Bastian. He's the implacable CEO of Delta. It was on Squawk on the Street. And he agreed with me that we could be on the cusp of the greatest boom in American history. Unlike me, Ed's not given to insane, or some would say inane, hyperbole. Suddenly, though, the bond market's behaving as though a boom is not only not in the cards, but maybe a huge slowdown is. Hey, so what's real? What's fake? Are we looking at a roaring 20s scenario, or will we soon be dead in the water? In other words, is it time to rotate out of the industrials and swap into something more defensive? Something like the most hated group in the entire market. Something like healthcare? Surely they can't both be right, or can they? Before I get into this dilemma, I know many of you couldn't care less. If you only focus on electric vehicles, or maybe cryptocurrencies, or the gospel according to GameStop, the idea that interest rates could plunge while everyone's fretting about inflation, well, that's probably a real non-issue for you. These people are what I call single-issue investors. You know how single-issue voters only care about, say, gun control or taxes, ignore everything else? A single-issue investor only cares about their own stock or their own asset, whether it be Dogecoin or non-edible tokens. But for professionals who collectively run trillions of dollars, the money men and women whose whims pretty much set stock prices, that's what they do. When they do this, the scenario that played out today is simply not supposed to happen. You can't have copper, oil, lumber, plastic, linerboard, freight, and housing all roaring while interest rates are dropping like an anvil off the Empire State Building. When we get this bizarro confluence, a monsoon in the proverbial stock market desert, it's because a left-for-dead sector made a remarkable comeback. I'm talking about healthcare, which somehow became the cheapest group in the market right in the middle of the pandemic, and versus its history, it's incredibly cheap. This cohort has fallen so out of favor that it finally represented enormous value. It was just waiting for the signal to move, and at the signal, well, it happened. Given how monumental that move was, I bet it's far from over. Yet the Dow hit a new high based on strength in healthcare, not the cyclicals. First, though, let's set the scene so you know what the heck I'm talking about. For most of last year, the stay-at-home stocks roared, while the go-about-your-business stocks wallowed. But once we realized that Pfizer and Moderna vaccines were right around the corner last November, the great reopening stocks took off, and they haven't looked back since. All sorts of experts like to come on TV and frame this as a tug-of-war between growth stocks and value stocks. How many times have you heard that, right? With value roaring over the last 6 months. But you know what? I think they're being willfully obtuse, not unlike the warden in Shawshank. Value stocks are only value stocks when they're cheap. It's not a fixed category, for heaven's sake. If you want to understand this move, it's not about growth versus value. It's about secular growth companies that can thrive in a weak economy versus cyclical growers that only do well when the economy's on fire. We didn't have the rotation into value, for heaven's sake. We had a rotation into cyclicals. You really can't call them value names anymore because they've run so much. While the secular growth stocks, well, they've been crushed. But today, that move stopped in its tracks. Money rotated back into the newly beaten down tech stocks. Yes, the real high growers. But it really rushed into the healthcare names. Yeah, healthcare. The most forlorn sector, punished endlessly. To the point where even Pfizer, a fabulous company, good yield, that's making a fortune from COVID vaccines, had been in retreat. Didn't matter. The group was out of style on the Wall Street fashion show. At least it wasn't until today. Yes, today the healthcare cohort, wow! Aided by it really all started in the morning. Excellent earnings from United Health Group. Yeah, UNH, the insurance provider, which also happens to be a component in the Dow Jones Industrial Average. On top of that, oh my God, this was something that just shocked me. Elliott Management, the brilliant activist hedge fund, it turns out that they've been building a significant stake in GlaxoSmithKline. Both stocks jumped about 4%. GSK. Wow. Whew. All right, anyway, the high spirits extended to the downtrodden Eli Lilly, where shareholders, including my charitable trust, have suffered immeasurably the pain from the vicious panning of the company's Alzheimer's drug. The rally also ignited Regeneron, which has a terrific treatment for severe COVID that helps get people out of the hospital faster. Remember, this is what they gave Trump. Somehow, neither the CDC nor the NIH has gotten behind Regeneron's terrific drug. I think this is total negligence by the U.S. government. The governor of the COVID-besieged state of Michigan, Gretchen Whitmer, sang its praises in a speech yesterday, giving the stock new life. CDC and NIH, will you stop putting the hate on Regeneron? All right, the hospital managed care, medical device, drug stocks, they all rallied hard today, too. How hard? Even the beleaguered Johnson & Johnson managed to go up. Now, the market didn't overlook the fact that we got some blowout retail sales numbers, allowing many retailers to roar. And because interest rates went down, signaling lower inflation, the secular growth tech stocks that we all know and love, Twilio, Okta, Ring Central, how can I help you? They just soared. That's what happens when interest rates go down big. On the other hand, the banks gave up the ghost, not because they put up bad numbers, and numbers were all real good, more on that later, but because the smart money was betting that Fed Chief Jay Powell would have to raise short-term interest rates to combat inflation. And that's such a cliche. And rate hikes are good news for the banks. But when you see bond yields plummeting, that suggests those rate hikes might not be coming anytime soon, so the banks can just get viciously pummeled. Where do I come out? I still believe Jay Powell is right. The current bout of inflation will prove to be temporary, meaning interest rates can keep falling. When nearly everyone is betting the same way, like how everyone thought rates were headed higher when we came in today, the market tends to make them look like knuckleheads. So I'm calling today a real knucklehead day. Or to put it another way, I think that the left-behind healthcare stocks are now coming back to life at the expense of the cyclical growth plays. And you should grab one before they all really take off into the it's the right firmament. Bottom line, the healthcare cohort has wandered in the desert long enough, and they're now surfing the Dow Jones River, taking it to new heights, even as they were supposed to be drowning in the deep, never to be seen again.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.